Okay, let's talk about a really powerful way of looking at the market, one that's actually been around for about a century. It's an approach that teaches you to read price action, well, like a story, to see the plot, figure out who the main characters are, and really understand the why behind every single move. And this quote right here, it just nails the huge mental shift we're talking about today. This is the key to getting away from all that stressful guesswork and moving toward a smarter, reactive approach. It's about learning to listen to the market, not shout orders at it.
So, how do you learn to read that story? What language is it even speaking? Well, the market absolutely has a language, and its grammar is basically dictated by the actions of its biggest players. The secret to decoding it all lies in the century-old method, designed specifically to understand the intentions of what we call smart money. So here's how we're going to break it down. First, we'll look at the big picture, the story itself. Then we'll dive into the four acts of the market's play. After that, we'll learn its language, learn how to spot the sneaky plot twists, and finally, connect it all to a field of mathematics that's surprisingly relevant. All right, first things first. The absolute core of this whole thing is making a shift from trying to predict the future to simply reacting to what's happening right now. It's all about building a simple, logical, if this, then that process, based on price action, which helps you take emotion out of the equation and just focus on execution. So, how do we build that framework? We start by seeing the market not as just a bunch of random noise, but as a story that plays out in four distinct phases, over and over and over again. And here it is. This is the whole playbook. At its heart, this entire cycle is about the strategic transfer of assets from the big institutional traders, the strong hands, over to the general public, and then, you guessed it, right back again. Think of it as a constant cycle of preparation, action, and then the inevitable conclusion. So the story always starts here, in the accumulation phase. After a big price drop, when everyone is feeling bearish and negative, the smart money is quietly buying. Now, why quietly? Because if they bought up everything all at once, they just drive the price up on themselves. So instead, they patiently absorb shares while the market is calm and going sideways. Okay, so once they've soaked up all the available stock, the path of least resistance is up. This is the markup phase. This is the obvious uptrend that starts to get everyone's attention and attract more and more public participation. The story's exciting second act is officially underway. Now, just like they bought quietly when everyone was scared, the professionals start selling quietly when everyone is euphoric. This is the distribution phase. While public enthusiasm is hitting a fever pitch, the strong hands are carefully offloading their positions to all the latecomers. Again, in a sideways, churning market. This is also where they might throw in a plot twist, like an upthrust, to trap all those eager buyers. And that brings us to the final act. Once the pros have sold off their shares, that underlying support is just gone, and the price starts to fall. This markdown phase is fueled by the fear and panic of all the people who bought near the top. It creates a clear downtrend and, of course, sets the stage for the whole cycle to begin all over again.
Okay, so we know the four phases, but how do you know which phase you're in right now in real time? To do that, we need to learn the market's language, and it's built on a fundamental law: effort versus result.
The concept is actually really simple. The effort put in should match the result you get out. In the market, the effort is just the volume, how many shares are being traded. The result is the price change. When they're in sync, the story is moving along logically. When effort and result are moving together, we call that harmony. So, for example, seeing high volume on a strong upward move, that makes sense, right? It confirms a healthy trend. But when they're out of sync, let's say you see a massive amount of volume, but the price barely budges, we call that divergence, and that is a huge clue that the current trend might be running out of gas. You can even see this whole concept play out on a single candlestick. I mean, look at that last candle there. The volume bar below it is huge. That's a ton of effort. But then look at the price candle itself. It's tiny. All that buying and selling produced almost no result. That's a classic red flag, a perfect example of divergence. And we can zoom out too and see this relationship across entire price waves. In a really healthy uptrend, the big moves up should have higher volume than the small dips or pullbacks. This shows harmony, and it confirms the underlying strength of that trend. Now, within this whole four-act play, there are these key moments of deception, the plot twists. These are very specific moves designed by the big operators to mislead the public, to shake them out of their positions, and to make sure the path is clear for the next big move. One of the most famous of these is the spring, or what some people call a shakeout. This thing is the ultimate head fake. The price will suddenly plunge below a key support level, tricking everyone into thinking a big breakdown is happening. This move is engineered to do one thing: shake out all the nervous sellers and trap them on the wrong side of the market right before the real move up begins. A spring usually happens right here, in what we call phase C of an accumulation range. It's basically the final test. The pros create this little bit of drama to absorb the very last bit of selling and to confirm that all the supply is gone before they launch the price into that markup phase. On a chart, a spring might look like a single, sharp candle with a long tail, or maybe a few candles that dip down and then reverse right back up. You know, a great analogy is a runner taking a few steps back to get a running start before making a powerful leap forward. That's the spring. You know, this whole idea of the market moving between these distinct phases, accumulation, markup, and so on, it's not just a trading concept. It brings us back to that reactive, if this, then that way of thinking, and it actually has this fascinating parallel in the world of mathematics. The concept is called a Markov chain, and put simply, it's just a way of modeling systems that move from one state to another. And it gives us this really powerful mathematical lens for looking at how the market transitions between its phases. The most important part of a Markov chain is something called the Markov property. All it says is that to predict the next state, you only need to know the current state. That's it. The entire history of how it got there is irrelevant. And this is the mathematical heart of that whole if this, then that approach we talked about at the very beginning. Let's make it super simple. Imagine a restaurant's menu for tomorrow depends only on what they serve today. So if today is hamburger day, there's a 60% chance tomorrow is going to be pizza day. And it doesn't matter what they served all last week. That's the core idea. And it perfectly mirrors how the market's next phase is determined by its current condition. By learning to read the story the market is telling you, by understanding its phases, its language, and its plot twists, you can totally shift your approach. You stop being a passenger just hoping for the best, and you become the navigator, reacting to the story as it unfolds in real time. So the question is, if the market is always telling a story, are you listening?